Okay, guys. In this video, I'm going to explain SMT divergence and time and price theory. Okay. Now, it's important you get a jotter, you get a note, and you write things down because I want to try to explain the theoretical aspect of it before delving into the chart and showing you examples. All right. SMT. So let's start with SMT divergence. Then I would move on to time and price theory briefly. I think most of you already have a good understanding of time and price theory. You know the Q zones and the like. So I won't spend that much time on it. But what I would do is to just draw your attention to important things you need to know. Okay. So SMT divergence is a concept taught by the Inner Circle Trader on YouTube. Okay, you can check out his YouTube channel if you want to have a more in-depth understanding of this concept. Okay, that is where I learnt it, and um, he has a lot of rich videos on his YouTube channel. Okay, so um, without further ado, let me go into the details. Okay, for you to understand SMT divergence. Okay, by the way, divergence stands for smart money tool or smart money technique or smart money timing. Okay, whatever you want to call it. Okay, basically a way that allows you to know when price is about to go up or it is about to go down. All right, with a near perfect accuracy of more than 90%. Okay, so for you to understand SMT divergence, you need to understand currency pairs and currency correlation. Okay. Um, when you say, let me type it out. When you say EUR USD, okay, when you say Euro USD, okay, what it um basically means is that, where is it? Let me Euro USD. Let me just type that out. Okay. So when you say Euro USD, let me use yeah, or you say GBP USD, or since most of you guys on the Telegram group page are mostly crypto traders, let me also add BTC USD or BTC USDT since that's what most of you are familiar with. So we have these are currency pairs. Okay, Euro USD, GBP USD, BTC USDT. Okay, these are currency pairs. Okay, now for you to understand SMT divergence, you need to understand currency pairs. You need to understand how different currencies relate with one another. All right. Now, when you see something like this, where you see two pairs being weighed against one another like this, what you are basically doing is weighing the value of one currency against another. Okay, so basically what we are doing here is we are weighing the value of euro against the dollar, GBP against the dollar, BTC against the dollar. So when we say BTC USDT is let's say $20,000, what we are basically saying is that for us to buy 1 unit of BTC, we will need 20,000 units of USDT. Okay, so if we say Euro USD is 1 point something, what we are saying is that for us to buy 1 point something units of Euro, we need, okay, I mean, for us to buy 1 unit of Euro, we need 1 point something units of USD. Okay, that's pretty much what it means. Okay, so if we say that GBP USD is 2. For example, of course, we know GBP USD is not 2. If we say it is 2, what it simply means is that for us to buy 2 units of GBP, we'll need, and for us to buy 1 unit of GBP, we'll need 2 units of USD. That's what it means. Okay. The first currency here is the base currency, while the second currency is the quote currency. So base quote, base quote. Okay, so we are weighing the value of the base currency against the quote currency. All right. And whenever you are buying the base currency, what you are also doing is you are selling the quote currency. Okay, so when I'm buying euro, I'm selling USD. When I'm buying GBP, I'm selling USD. When I'm buying BTC, I'm buying USDT. I think most of you should be able to relate with the BTC example. If you want to buy BTC, you have to have USDT. Okay, so when you are buying BTC, you are selling your USDT for BTC. Okay, so if the price of BTC USDT is $20,000 or 20,000 USDT, okay, for us to buy 1 unit of BTC, that means we need to have 20,000 units of USDT. Okay, so whenever I'm buying BTC, I'm selling USDT. All right, so if I am buying euro, okay, now let me bring in supply and demand dynamics into this. Okay, I've told you a few times that um supply and demand does not really control the market. Okay, the market does not go up or down based on supply or demand per se. Okay, the market goes up or down based on the algorithm, IPDA algorithm. Okay, the algorithm considers supply and demand pressure or supply and demand dynamics. However, that is not what determines the price, and that's not what determines the price. Okay, what do I mean when I say the algorithm considers the demand and supply dynamics? For example, that's one of the ways that market makers or BFIs, people with deep pockets, that's one of the ways they manipulate the market. For example, if they want price to go to a particular price level, what they sometimes do is to place large orders at that price level. And what the algorithm will do is to draw down to that level. Why? Because the algorithm is designed to move from area of liquidity to liquidity. Okay, so um however, it doesn't mean that they would always succeed. Okay, if the algorithm is designed to do something else, it will do it. If the algorithm is designed to go up, no matter how people are selling, it won't go down, it will go up. If the algorithm is designed to move price down, no matter how people are buying to keep the price up, it doesn't matter, it will push the price down. All right. So sometimes the deep pocket, people with pockets, the BFI sometimes may be successful in manipulating the algorithm to draw to a particular price level that they are interested in buying, but it's not all the time that they are successful with that. All right. So that's I want to explain that. But now let's assume that what I just explained to you is false in quote, just an assumption, because I want to bring in supply and demand dynamics into this um, to explain um SMT divergence. Okay, let us assume, okay, that the market move primarily based on supply and demand dynamic. That is, when you are buying, the price will go up. When you are selling, the price will go down. Okay, we're assuming that there is no algorithm you know that moves the price now. Okay, we're assuming the assumption. Okay, this is not a correct assumption. This assumption is only correct in certain markets like the commodities market. The commodities market is based majorly on supply and demand dynamics, because there is an actual supply and there is an actual demand for goods, physical products. Unlike in the currency market where there is no physical product, or in the cryptocurrency market where there is no physical product. Okay, but let's assume that we're assuming that this market, or what I'm about to explain, is majorly based on the supply and demand dynamics. Okay, so If it is based on supply and demand dynamics, just assume for the sake of understanding this concept, all right? If we are buying euro, then that means we are selling USD. I already explained that. If we are buying BTC, that means we are selling USDT. All right. So let us assume that when you are buying a product, we are buying a currency in this case, okay, the price goes up, right? Because there is demand for it, basic economics. Okay. When demand is high, you are expecting that the price should go up. And when the price goes up, remember I said when you are buying this, you are selling this. So if you are buying this and this is going up, you would expect that USD should go down, right? Okay, in other words, if more and more people are buying BTC, you are expecting that BTC should go up. And because whenever you buy BTC, you expect USDT to go down, right? Okay, why? Because you are selling USDT. Remember, I explained earlier on that when you are buying the base currency, the quote currency, you are selling it. Okay, so you are selling the quote currency to buy the base currency. So when you are buying the base currency and price, you expect that price should go up, right? Now, if price is going up, then you would expect that the USDT, the quote currency, should go down, right? So if euro is going up, you expect that USD should go down. If GBP is going up, you expect that USD should go down, right? Is that simple enough? Okay, so that is what you will expect under normal circumstances, all right? Now, these currencies, some currencies, they relate with one another. Okay, there are certain currencies that when one goes up, the other goes down. When one goes up, the other follows suit. Okay, now this is what you call currency correlations. All right, so before you can understand smart money concept or smart money tool, SMT divergence, before you can understand that, you also need to understand currency correlations, currency coefficients, and all of that, which is what I'm going to explain now. Like I said, get a note and write this down, okay, so that you can refer to it from time to time until you have a good understanding of what I'm about to explain. Okay, so um correlation is basically a term that describes the relationship between two different currencies, okay, in terms of how they move. For example, if one goes up, whenever one goes up, the other goes down, or whenever one goes up, the other follows suit. They are said to be correlated. That is, there is a relationship between the two currencies. Okay. Now, currency correlations are measured based on what we call currency correlation coefficients. Okay, it is a number or a value that ranges between -1 to +1. Okay, -1 to +1. Okay, so let me just draw something to illustrate that. So let us assume you have this, okay, and here's my text. Okay, let us assume we have one in here. That's 1. That's the value of 1. And here we have, that should be plus, this should be +1. And here we have -1. Okay, and at the middle, okay, so let me try and get the middle. Can I get the middle? I can't get the middle. So let's just assume this is the middle. Just an assumption that this is the middle. The middle would be 0, 0. Okay, so currency correlation is measured based on, so let us assume we have 0 from -1 to 0 to +1. Okay, now when two currency pairs have a correlation coefficient of -1, what it means is that they have perfect negative correlation. That is, whenever one is going up, 100% of the time, that is 100% of the time, whenever one is going up, the other will definitely go down. 100% of the time. That's a negative correlation of -1. Now, when you have a positive correlation of +1, what it means is that it is a perfect positive correlation. That is, whenever one of the currencies is going up, the other currency would also go up 100% of the time. All right. And a correlation of zero means that they are not in any way related, in any shape, way, or form. They are not related at all. They just move randomly of one another. Okay. Now, without understanding, certain currencies, Euro USD, GBP USD, or DXY, let me add DXY to this, or DXY. DXY is the dollar index. Okay. That's dollar. Okay. That's the dollar. Okay. So certain currencies are correlated. For example, Euro USD and GBP USD, you will expect that they have a correlation of almost, I think, zero point 0.7, I think something around 0.7, 0.75. Euro USD and GBP USD. So you will expect that 70 to 75% of the time, um, whenever Euro USD goes up, GBP USD should go up. Whenever GBP USD goes down, GBP Euro USD should come down. Pound USD should, so whatever this does, this should do. Okay, that is the correlation between them because they are positively correlated. Whenever Euro USD goes up, Pound USD would also go up. Whenever Euro USD goes down, Pound USD would also go down. That is what it means, right? Now, there is also negative correlation between dollar and most foreign currency pairs like Euro USD, Pound USD, even BTC USD sef. Okay, so you expect that if the dollar, this is dollar, okay, dollar is, this is like the USD equivalent, alright? So, sorry. So, if, remember I explained earlier on that if euro is going up, that's if you are buying euro and euro is going up, then USD should go down. USD is the DXY, is the dollar index, all right, DXY, which is this chart, dollar index, right? So, sorry, um, so we can say that Euro, USD, and DXY, they are negatively correlated. That is, if Euro USD is going up, you would expect that DXY should go down, all right? And if Euro USD is going down, you will expect that DXY should go up. Okay. Same thing applies to Pound USD. Same thing applies to BTC USD, USDT. Okay. Now, whenever there is a crack in correlation between two currency pairs that are either positively or negatively correlated, that is when you say that there is an SMT divergence. Alright. In other words, remember I said when Euro USD is going up, you would expect that DXY should go down. If instead of going down, DXY is going up, what you see there is what you call an SMT divergence. Okay, what it simply means is that DXY is unwilling to go down, and as a result, it means that DXY is being accumulated by deep pocket, by smart money, and they want to push the price up. That's pretty much what it means. Okay, you expect that if euro is making higher high, you expect that DXY should make lower low. Remember, when euro is being bought, is going up, DXY should be selling off based on that concept I explained to you on supply and demand dynamics. All right. Remember, supply and demand dynamics is not what controls the market, is not what moves the market. The algorithm considers it, but that is not what ultimately determines the price that is being delivered. Okay, so whenever there is a crack in correlation between two currency pairs where one is making higher high and instead of the other one to make a lower low, the example of Euro USD and DXY, that is what we call a crack in correlation. That is what we call SMT divergence. What it means is that whenever there is that crack, Euro USD making higher high, DXY unwilling to make lower low. Under normal circumstances, when Euro USD makes a higher high, you would expect that DXY should make a lower low. But whenever it fails to do that, what it simply means is that DXY is being accumulated and it is going to run up. Now, if DXY is being accumulated and it runs up, then that means Euro USD will therefore now go down. Okay, so let's look at some examples here. This is DXY chart on my left, and this is Euro USD chart on my right. You can see that whenever um, DXY is going up, Euro USD is going down. Why? Because they are negatively correlated. Okay, they have negative correlation. Okay, now if you find a situation whereby Euro USD is going up and DXY is unwilling to go down, that is what you call an SMT divergence. Okay, so let's look at a few examples here. Um, Look at this place. Okay, look at let me draw it. Look at this right here. Okay, look at that. Here, Euro USD is making a higher high. It's making a higher high, but DXY is unwilling to make a lower low. You can see. Look at this line. Look at this line. Look at that crossbar. This vertical line that is showing here, and this vertical line. Let me delete this. Let me just hide it so that it won't confuse you. Okay. Here you can see that I think I'm done with this. Let me just delete it. Okay, so here we see that dollar is making a higher high. This is making a higher low. This is making a higher high. Okay, under normal circumstances, when Euro USD is making a higher high, remember dollar is supposed to make a lower low, but instead it is making a higher high. That immediately tells you that it is being accumulated. Okay, the dollar is being accumulated and it is about to run up. And what do you see after? You can see it ran up and then euro ran down. Okay, so whenever you see this crack in correlation where euro USD or GBP USD is making a higher high and the DXY is unwilling to make a lower low, what it simply means that euro USD is about to run down and the dollar is about to go up. Okay, that is SMT divergence. So when you see this, okay, when you see this, like I said, look at this arrow. You can see this low correspond to this low here. This low right here, this one. Just focus on this crossbar that is moving on the left and the right. Okay, there's a crossbar that is moving. So if I place the crossbar here, look at Euro USD, look at that high. You can see that that low corresponds to that high. Okay, now if I move the crossbar to this level, you can see that this low here corresponds to that high. So at the same time that Euro USD is making a higher high, DXY failed to make a lower low. Under normal circumstances, it should make a lower low. Okay, remember, it should make a lower low, but it failed to do that. So that's what you call a crack in correlation. That's what you call SMT divergence. Okay, when you see that, what it means is that the dollar is about to run up, and if the dollar runs up, euro USD is going to run down, and GBP USD is going to run down, and every other foreign currency is going to run down. That's what it means. All right. I believe that concept is simple enough. Now, let me show you another example. Here, right here, you can see here, euro is making a higher high. This is the daily time frame anyway, higher high, while you can see, just place your cursor. Look at this low here. This low corresponds to that high right there. Okay, so euro is making a higher high, while DXY is making a higher high. When euro is making a higher high, you expect DXY to make a lower low. All right, but instead, DXY is making a higher high. Okay, they are meant to be negatively correlated. Okay, they are negatively correlated. So when you compare the DXY chart and the Euro USD chart, you expect that when Euro USD is making a higher high, based on that concept I explained to you, when the base currency is making a higher high, that means it is being they are buying it. Okay, it is going up. All right. If it is going up, then you expect the quote currency USD to go down, but it is not going down here. That is a crack in correlation. That is SMT divergence, smart money tool, smart money technique, or smart money timing of accumulation. Okay, so when you see this kind of situation, you expect that the dollar index or dollar is going to run up while the euro is going to run down. So this is negative correlation. All right, this is what you call um negative correlation. So you can see what happened after. Rallies up, rallies up. One, two, three. For the whole of that week, it rallied up. And this one dropped aggressively. Okay, you can see dropped, dropped aggressively. Alright, so that is negative correlation. Now let's look at positive correlation. Like I said, I told you that Euro USD and GBP USD are positively correlated. Alright, they are positive correlated. So that is, if GBP USD is going up, Euro USD should go up. If GBP USD is going down, Euro USD should go down. Alright, so when you see a crack in correlation in which one of them is unwilling to go down or willing to go up following the other, then that is what you call an SMT divergence. Alright, so let me show you a few examples. Okay, right here. Okay, this is a plugin. There's a plugin I'm using that you know identifies this. It's not always accurate. Sometimes there's a lot of fake SMT divergence, so it's something you have to be careful of. Right, I'm going to show you the name of it. The plugin is SMT divergence by Nephew Sam. So when you add it to your chart, it's going to show you when there is an SMT divergence. But there is a lot of fake signal. So that's something you have to be aware of. There's a lot of fake signal that can, sometimes you think where there is an SMT, there is no SMT. So you need to, that's where timing actually comes. That's where time and price theory comes into place. It will take time. It will take time for you to actually understand, but maybe one of these I'll do a more in-depth breakdown of how you know when an SMT divergence is real and when it is fake. Okay, but for now, the two can still be really useful if you know what you are looking for. All right, this is an SMT divergence. Okay, just focus on this vertical line. Focus on that crossbar, the vertical line. If I drag it to this low, look at the same low, 340 on euro. Okay, so here we have a lower low, here we have a lower low, while Euro USD is making a higher high. So that right there is what you call an SMT divergence. So this is a bullish SMT divergence. All right. What it simply means is that Euro USD is being accumulated. So in these situations, usually you would want to avoid longing the one with the low, the one that is making lower low. You want to focus more on the one that is making higher high. And you can long both of them too. It doesn't really matter. For example, when I saw this was one I traded because I saw, did I even trade this? I'm not even sure I traded it. I think I didn't trade it, but I was just observing price. Okay, you see market maker buy model playing out. So I trusted this more because I know that the price is coming back to, most likely coming back to this level. Okay, if reaccumulation does not turn to redistribution. Well, I've explained market maker buy and sell model, but maybe one of these days I will. But this, let me just focus on self divergence. I don't want to um, be carried away with something else. Okay, so when you have this lower low and you have this higher high, that tells you that price is about to run up. Okay, I think I posted this. Did I? I think I posted this on the Telegram group page, and I told you guys that we're about to see a reversal. Okay, when I saw this, I said we're about to see a reversal. Yeah, I think I traded it. Was it this one or the previous day? I can't even remember. I can't even remember. All right, so that's what you call an SMT divergence. When you see Euro USD making a lower low, GBP making a higher high, or vice versa, that is an SMT. That is a bullish SMT divergence. Okay, that is what we call a bullish SMT divergence. All right, there's a bearish SMT divergence here. Look at this high. Okay, this high corresponds to this high. This high corresponds to this high. All right, this is making a lower low, while this is making a higher high. Okay, don't forget they are positively correlated. So if GBP USD is making a lower low, you expect that Euro USD should make a lower low, but it did not. Okay, did not. Okay, so that tells you that there is a heavy distribution going on. Okay, and when one of them fall, it will pull the other with it eventually. Okay, personally, I like to short the one that is failing to make a higher high because that one is weak and this one is strong. Okay, this is a strong pair. You can see that eventually when it dropped, it was unwilling to make a lower low because this is a stronger pair, this is a weaker pair. Okay, so you want to long the stronger pair and you want to short the weaker pair, or you short both of them. Okay, sometimes I short both of them. But I might reduce my risk for the stronger pair if I'm shorting the stronger pair. Sometimes I just focus on the weaker pair. Alright, so this is a bearish SMT divergence. Alright. Under normal circumstances, you expect that when Euro USD makes a lower low, when pound USD made a lower low, you expect that Euro USD should make a lower low as well, but it failed to. So that tells you that pound USD is heavily being distributed. So that is, there is heavy selling going on GBP USD. So you can anticipate that there is going to be a heavy drop. Same thing applies there. You can see the heavy drop. So you see bearish SMT divergence, bearish SMT divergence, bullish SMT divergence. So that is SMT divergence. Let me just show you a few more examples. Um, this is another one right here. Okay, you can see the fake SMT devices I was talking about if you are using this plugin. So don't trust the plugin, right? You need to put into consideration the concept and you need to look at the timing in which it is occurring. Okay, so look at this right here. Let me even disable this so that you don't get confused. Okay, yeah, it's cleaner now. You can see from here that this is making a higher high. why this is making a lower low. Okay, so that tells us that GBP USD is heavily being accumulated. So you want to long, you can see that it is dropping into a fair value gap, and then there is other block right here, down close candle. You can see this other block right here. That's a down close candle. So that tells you that it is about to run up. Okay, that's what it means. This one that is being heavily, this one that failed to make a lower low is being heavily accumulated, and you can see it ran up after. It ran up after that. All right, so that is a bullish SMT divergence. And maybe one more examples. Okay. Um, this is another one right here. Another one. You can see that there's SMT. Look at my line. Look at the vertical line. You see that this vertical line right here, this high here corresponds with this high. Okay, just look at the vertical line. This high corresponds to this high. So here we see a higher high on pound USD, while here we are seeing a lower low on pound USD. You can see higher high, lower low. That is SMT. You can see the aggressive sell off that happened after. You can see the aggressive sell off that happened after, the aggressive sell off that happened after. Alright, so when I see this, I like to short the weaker pair. You can see this one did more in terms of pips. This is 110 pips. This is 100, almost the same thing. Basically the same thing, 111. Basically the same thing. But personally, I like to short the one that makes the lower low. I prefer that. I prefer shorting the one that makes the lower low. And sometimes I short both of them as well when I see a bearish SMT divergence. So when you see this, you know that a heavy distribution is going on in the pair. Okay, so that is how you know when price is about to drop, when you know price is about to go up. That's how I figure, that's how I know. Okay, so um I hope my explanation on SMT divergence is simple enough. I hope it is simple enough. This is another one right here. You can see this is making a higher high, while this one is making a lower low. That's abnormal. Okay, under normal circumstances, like I said, you would expect that when this one is making a higher high, this one too should make a higher high. So whenever this makes a lower low, it tells you that this is heavily being accumulated. Okay, and then you want to long the one that is making the higher high, and either ignore the one that is making the lower low, or you can maybe long both of them. But personally, I like to focus on the one that makes the higher high. Okay, that's another example of SMT divergence. I can keep on showing you more and 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 more examples. Okay, now let me briefly explain time and price theory. What time and price theory simply um, means is that time comes before price. In other words, there are certain times where you expect certain occurrences, you expect certain things to happen. Okay, specific times in which you would expect that certain occurrences, certain things should happen. Okay, specific times in which you expect certain things to happen. Okay, that is That is what is it called? That is what you call time and price theory, right? Now, the first thing you need to understand about time and price theory is understanding the Q zones and the weekly, the Q zones and the daily open. Okay, if you are a scalper or a day trader, the daily open and the Q zones. Okay, for the Q zones, you can use this indicator I've given you guys before, ICT Q zones. All right, ICT Q zones. Once you add it, it will automatically show you the window of time to look for your setup. Okay, so you are looking for specific setups within this window of time. Now, there are four Q zones: Asia Q zones, London Q zones, New York Q zones, and London close Q zones. London open, New York, London close, and Asia Q zones. I'm not going to go into the specific characteristics of each of the zones, but what you just need to know is that when you are looking for setups, only look for setups within the Q zone. Okay, so when you say market structure shift within the Q zone, I trust it more. You should trust it more. If you say a market structure shift outside of the Q zone, don't trust it. Now there are times it will play out. Okay, there are times when it will play out. There are times you see setup outside of the Q zone and the setup will still play out. But generally, if you want to increase your hit rate, your accuracy, focus more on looking for setups within the Q zone. Okay, so either within the Asia Q zone, the London Q zone, um, the London Open, or the New York Q zones, or the London Close Q zone. Now, one thing you would observe from the SMT examples I've showed thus far is that most of these setups, most of the setup, they happen inside of the Q zone. Okay, you see them inside of the Q zone. You can see London Q zone. What do you see here? This is SMT divergence happening inside of the London Q zone, happening inside of the London Q zone, happening inside of the London open Q zone. Okay, let's look at the other examples that I showed you. What do you see here? Inside the London Q zone. This is inside the London Q zone. Okay, let's look for more examples. This is the other one I showed you. This is making a lower low, while this is making a higher high. Where is it? I think right here. Yeah. Making a higher high, making a lower low. You can see that it went up after. Quite choppy, but you can see it went up after, went up after. So that tells you that when I see this, sometimes I just buy this. Sometimes I buy this, sometimes I buy this, sometimes I buy this, even without, this is a stop hunt. Okay, sometimes I buy into the stop hunt and I use like 10-15 pips or more as my stop loss, and I just ride it for 2 or 3 hours. Okay, so you can see it's happening. This one is happening inside of the New York Q zone. This one London close between. Now let me explain. I told you that you can use this indicator ICTQ zones by Tradinator. Um, but there is a bit of correction, or a bit of a correction you need to note. New York Q zone runs from 7 to 10, not 9. Okay, this indicator is showing 9, but it runs from 7 a.m. to 10 a.m. New York time. Okay, so New York Q zone and London Q zone are connected together. So London close Q zone starts from 12. Okay, why I may start from 10 and ends at 12, while New York Q zone runs all the way to 10. Okay, so they are joining together. So this is actually happening inside of the Q zone, okay, inside of New York Q zone, in between New York Q zone and London close Q zone. All right, so this is What I mean when I say time and price theory, you're looking for specific setup to occur or happen within specific window of time. Okay, so when you're looking for SMT divergence, you want to make sure that SMT divergence is inside of the Q zone. You can see inside of the London open Q zone. Okay, I think that was the last example I gave. This is the last one. London close Q zone. You can see London close Q zone. All right. Um, this is another SMT divergence in here. You have this one between this high and this high. You see a higher high, while this one is making a lower low. Right there. Okay. Making a higher high, while this one is making a lower low. So that is this is also happening inside of between London, between New York Q zones and London close Q zone. New York Q zone and London close Q zone. Remember, New York Q zone and London close Q zone are linked together 7 to 10, 10 to 12 New York time. All right, so that's this is another SMT divergence. This is making an equal high while this one is making a lower low. Okay, that happening inside where inside London open Q zone. Okay, so specific time before price. Okay, you wait for certain time and then you start thinking about price delivery. So the algorithm that delivers price checks time first before it delivers price. That's basically what it means. Okay, and these are also the period in which the market makers or the BFIs, people smart money, this is where they are accumulating or where they are distributing. All right. So I hope that is explanatory enough. I hope you understand the concept of smart SMT divergence and time and price theory. Okay. Now, other things you need to understand about time and price theory is that the high and low of the day, if we are bearish, okay, let's say if we are bearish, the high of that day would be formed during the London open Q zone. Okay, you can see this is London open Q zone, London open Q zone. The high formed that day and then it dropped aggressively after. And the low will usually be formed either during New York or London close Q zone or maybe outside of it in some instances. Okay, now, like I said, another thing you need to know as far as time and price theory is concerned is the open, okay, 12 midnight time, New York time, okay, 12 midnight New York time. Once you mark it out, if you're expecting that price should be bearish, you want to see price rally up. Okay, you want to see a rally to the upside. That's when you want to buy. When it rallies up, you want to buy and you wait for the drop to happen all through the day. Okay, so let me show you a few examples from my oh I'll need to create another video to show you as an example from my daily map. Okay, I do a daily map of the price action at the end of the day, so I can show you more exact. Should I just show you here? Okay, let me just show you here. Let me show you here. So you can see, let me use this 15-minute time frame so that it will be easier. You can see on this particular day, the low of the day formed during the London Q zone. This is the low of the day during London Q zone, and the high of the day formed during the London close. It will either form during London close, New York, or post London close. All right, let's go to Thursday. Where is midnight New York time? Midnight New York time will be somewhere around here. This is midnight New York time here. Okay, so that is when the day starts from the algorithm's perspective. midnight New York time, you can see the low of the day formed during London Q zone. Okay, the low of the day formed during London Q zone. Okay, and then see it rallies up after. Here, the day was bearish. Where is London? Where is midnight New York time? This is midnight New York time. Okay, from midnight New York time, what I say, you expect price rallies down and then rolls up from London open Q zone, rallies up. This rally is what you call a Judas swing. Okay, when you see me say I'm waiting for Judas swing, this is what it means. This is Judas swing. Okay, this is Judas swing when um during London Q zone, if you're expecting that day, if you're expecting price to be bearish, you want to see that price runs runs above the um midnight price. Okay, so when you draw it out in time, let me just show you. So if I draw a vertical line at 12 o'clock midnight time, this vertical line right here, let me make it more solid, maybe blue, so that you can see it. Yeah. So this is midnight New York time. If you draw a line, that's what you should see me draw sometimes when you look at my chart. If you draw a line from midnight New York time, you draw it out, okay, and you expect that price is going to be bearish for that day. What you want to see is you want to see that during London Q zone, okay, during London Q zone from 2 a.m. to 5 a.m. New York time. Okay, you don't need to cram it, you can use the indicator, you can add it to your chart. Just make sure you change um your time, your trading view time to New York time, UTC -1. Okay, so exactly between 2 a.m. and 5 a.m. New York time, if you're expecting that price is going to be there, you want to see a rally up, okay? Let's say rally up that will form the high of the day during London Q zone. Okay, you can see the high of the day formed, and the day ends by 4 p.m. Okay, that is when the day closes from the algorithm's perspective, 4 a.m. So you can also mark out 4 a.m. on your chart. Okay, 4 I mean 4 p.m. rather, 4 p.m. on your chart. That is when the day close. So the true time from the algorithm's perspective is between 12 midnight and 4 p.m. New York time. Okay, so after this, you shouldn't be entering any new position. Okay, until the next Q zone, which is this 7 a.m. 7 p.m. New York time. That's when Asia Q zone begins. Okay, you can see the high of the day formed during London open Q zone. Okay, and the low formed during New York Q zone. All right. So let's go to um, Tuesday. Let me add the midnight time. This is midnight time. Okay. And this would be 4 a.m. No, let me just add that. Okay. Just to save time. All right. So this is midnight time. What you want to see is you want to see that price rallies above the midnight price. Okay. This is midnight price. This is the open price. We want to see that price goes above it to form the high of the day during London open Q zone. Okay, remember this was that short that I took. I shorted the very top. Okay, why did I have the confidence? Because I know that this is London. I was expecting bearishness for that day, but I wasn't expecting it to be this bearish. I really was not expecting that price would be this bearish. All right, if not, I would have held on to my trade and just write it down. That would have been a sweet long trade, a sweet short trade rather. So you can see on Tuesday again, the high of the day formed between 2 a.m. and 5 a.m. London open Q zone, New York time. Okay, and this repeats every day, day in, day out. It repeats. Okay, this is the difference between forex and crypto. That's why I said I've stopped trading crypto, because in forex you know specific time that certain things would happen. You know it. You know specific time that certain things would happen. Okay. Um, and then the low of the day formed during London close. Right. The low of the day formed during London close. Like I said, the low of the day would either form during London close or New York Q zone. Okay. Let's move on to Monday. There's Monday. Where is this is the midnight time. Okay. And here this is another SMT divergence. All right. Midnight. This is midnight. Yep. You can see we have an SMT divergence during London. This one is making a higher high, while this one is making a lower low right here. Okay. And see, in this case, this one rallies or went up higher than this one. Anyways, um, because of this heavy accumulation that happened prior to the move. Okay, so this formed the low of the day. You can also see from here that this is the low of the day. Maybe this is the low, though this is the low of the day. In this case, this is an SMT. That's why this is not forming the low of the day. This is an SMT divergence, and this is an SMT divergence. All right, so it formed the low and then it rallies up, and then the high of the day formed during New York Q zone, and then you see this heavy drop that follows after. All right, so let me move on to Friday. Okay, this is New York Q zone. This is 12 a.m. New York time. Like I said, you can see this is Judas swing. Price rallies up as Judas swing before it then sells off, forming the high of the day during London Q zone. Okay, before it then drops. We can see another SMT divergence here. You can see between here, lower low, while this one is making a higher high. This one is on the 15-minute time frame. Okay, we check the one on the 5-minute time frame prior to before now. So higher high, lower low. So it rallies up, forms the high of the day. Judas swing forms the high of the day during London Open Q zone, and then see the sell off. So this is price. This is time before price. Same thing on Thursday. Okay, you can see during London Q zone, you see that rally to the upside that formed the high of the day, and then New York forms the low of the day. All right, before it then rallies up. And normally after 12 o'clock, you don't want to enter any new position after 12 o'clock. Once it's reaching 11 or 12 o'clock, New York time. Okay, just know that whenever I'm calling time, I'm referring to New York time. Okay, because that is the time that the algorithms follow. Okay, so you can see from multiple examples that most of the time, more than 75% or even 90% of the time, you would see that price would form the low of the day. If again we bullish, the low of the day will form the London Open Q zone, um, or the high will form during London Open Q zone if we are bearish. Okay, so you can go to your chart and back test, check. I have my own back tests. I can't show you here because my screen recorder is focused on trading view. All right, so and I can't, it doesn't have option to switch. So maybe I'll show you. I'll just take a screenshot and I'll post on Telegram group page. I'll take a screenshot of my journal showing the data. Okay, and I'll post it on the Telegram group page so that you see for yourself that more than 90% of the time this is usually what happens. 90% of the time this is usually what you would see. There's only few times that you won't see this, especially when there is some kind of divergence. Okay, when there is some kind of divergence, that's when you most of the time see that. Okay, so that brings us to the end of the video. I hope you understand the concept. If you have any question, you can always drop your question in the comment section on YouTube, or you should drop your question on the Telegram group page, and I would address them. All right, you can see another SMT divergence here. This is forming a higher high, while this is forming a lower low. All right, so we have a higher high, we have a lower low. You can see how the one that made the lower low dropped aggressively. Okay, you can see um that aggressive drop. Okay, you can also see another SMT divergence here. This one is making a higher high here. Is that an SMT divergence? Not really. There is really no SMT divergence here. There is no SMT divergence. Okay, so that's it. Okay, you can always drop a question again on the comment section or on the Telegram group page. All right. Next, I'm going to drop a video on I think on how to back test. Okay, a video on how to back test and how you can journal your back test and journal your trade. Okay, that will probably be the last video I'm going to drop, and then we'll start the $1,000 to 1 million challenge. Okay,